Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, September 13th, 5:39 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Back to a correction is the theme for tonight's video, as pre-market, the CPI inflation report came out, showed inflation is not slowing. The market, the futures pre-market were up about 0.75%, and they dumped immediately and dumped hard. We opened down 2.3% on the S&P and trended lower for pretty much most of the day, closing near the lows, absolutely crushing the hopes of any bulls out there. And you can see over here by the trend gauge, we went to neutral yesterday on short-term and medium-term as we were above the 50-day and the 21-day moving average, but back to bearish / downtrend on that. I don't need two closes below in this case because we gave back the last 3.5 days gains. Worst case scenario for the bulls, very clearly still showing neutral, but with a red arrow pointing toward downtrend bearish. Some leaders actually held up, a couple closed green, but no time to be a hero. When you're in a healthy market is when you want to participate in growth leaders. Otherwise, you're just like a salmon trying to swim upstream. Forget it. So all 5 moving averages on the major indexes, all 5 major indexes moving averages are below their short-term 21-day exponential moving average, medium-term 50-day moving average, long-term 200-day moving average. We'll check out the charts momentarily. You can see over here how bad the numbers were. Reiterating the headline, bad CPI inflation report kills rally. G6, our growth proxy, 6 ETF composite down 4.24%, S&P down 4.3%, NASDAQ 100 just blown apart, down 5.5%. These big cap stocks like Apple, Tesla, Amazon, Nvidia, Microsoft, Google, Facebook, nowhere to hide in these. Every one of them. The one that was down the least was Tesla, down 4%. Nvidia down 9.5%. You got to cover up the ticker, look at the chart, and go by that, or you can just get yourself ripped apart. I found this, I made up my mind not to go with, oh, well, it's ticker XYZ, I can hang in there with it, when I watched PayPal go down 20% in a couple of days in February, March of 2021. Forget that. We're here about preserving capital so that we can grow it during bull markets, not about trying to be a hero by picking a couple of good tickers. So Dow couldn't hide there either, down 3.9%, mid-caps down 3.7%, Russell 2000 down 3.9%, Global Diversified 60/40 stock and bond down 2.5%. In-house, our flagship GROTECTION down 1.76%, much less than the indexes. We were down 1.65% at the open and immediately started hedging and trimming positions, sticking to our stops, raising our stops. As the market continued to just trend lower, we just got taken out of the market, let the market make the decision for us. And any goodwill completely undone today by the reaction to this CPI report. So let's get into the charts, and we'll get into what we do here at Revere. GROTECTION is the name of our flagship portfolio. Growth during uptrends, protection during downtrends. Here's an uptrend last October, November, trending very nicely above the short-term 21-day moving average. That's the green line. The 50-day moving average, intermediate term, that's the red line. 200-day long-term, that's the black line. When things start to slow down or roll over, we start, just like today, we start, our stops start getting hit. The market takes us out. And when it really gets bad, it starts to roll over. The slopes of the lines will roll over. We'll get less and less involved in the market. And then if we get below this black line, that's the 200-day moving average, will be severely defensive, in a lot of cases all cash. In the case of today, we actually end up net short which means we can make money if the market continues to go down. This picture here is why we do what we do. Here is a picture of the last 13 bear markets going back to 1968. You say, well, Don, doesn't the market trend higher over time? Sure it does. If you're close to retirement, do you want to get caught in one of these negative 35, negative 40, negative 50% downtrends? And if you don't think it can happen right now, I'm sure you didn't think it could happen back in 2000 when the tech bubble burst, or in 2007, 2009 when the financial crisis hit, or maybe you thought COVID was no big deal and you dropped 35% in 5 weeks. Yeah, we recovered. But if you're close to retirement, are you going to take the risk? The average of the last 6 down 44.5%, which takes 80% to recover. We're going to protect capital and wait for better days. And don't tell me about paying taxes, because if you don't want to pay taxes, the market would be glad to just take the tax money from you and devastate your portfolio. So this is why we do what we do at Revere. If you're interested in finding more about it, email don@revereasset.com. I'd be glad to talk to you. Or reply to your email. If you call 855-REAL-WEALTH, that's 855-732-5932. You'll talk to Danny and he will answer any question that you have. But today is what's called a negative expectation breaker. We had a nice bounce. This 3,900 area held where it needed to hold for 4 days over the last 2 weeks, and then we started going higher. This was in anticipation. Even the New York Fed saying, we see signs of inflation taming. Well, the report that came out this morning sure didn't support that. And this day looks a lot like this day, 8/26, when Powell spoke. It looks a lot like this day, or this combination of days, when a hot CPI report came out in June. It looks a lot like this day on 4/21 and 4/22, where we tried to get above the 200-day moving average and failed miserably. So this is day 1 of the downtrend. Big days down like this, there can be some short covering, but usually they resolve lower, which they did in all 3 of the prior situations that I pointed out. Kind of looks like this day too, 5/5, where we were trying to rally, got into the 21, reversed lower, and ended up going quite a bit lower. So we're prepared for anything, but right now, again, with a day like this, completely undoing all the gains of the prior 4 days up, it's time to get extremely defensive again, and that's what we did, and we'll discuss that when we go through the tail of the tape. NASDAQ 100, same situation, big down day. Now we're at this all the way down to this last level of support, which is around 290, 291. In other words, the lows of last week. If we break those, not a lot of support going down to the lows from June. Dow Jones Industrial Average, same situation, looks a lot like the S&P 500. Also need to note that the stochastics, which turned up above 0, have had a hook down. That's a big negative. We'll mention that in the tail of the tape also. Mid caps, these have been outperforming. Not today, broke below the 21 and the 50-day moving average. And small caps, same situation, outperforming, not today, down below the 21 and the 50-day moving average. So all 5 of the major indexes back below that level. Let's take a look at the tail of the tape, and we'll talk through what we did in-house today. So updated technical, these were tailwinds prior to today, but the indexes, including the G6, they all had a daily stochastic hook lower. They all broke below their 21 and their 50-day moving average. VIX is over 26. I talked about that level of 24 to 26, above 26 being negative, below 24 being a positive. Back above there, we closed at 27.3, up 14.2%, and it's now above all the moving averages. This means there's fear in the market, and you should heed that fear. Put call ratio elevated, but not overly high. Fear and greed, we dropped 8 from 48 to 40. That's in the fear range. Bull case dead. Back to the bear case. Rally failure, break of the 21. First it was Powell on 8/26. Now it's the CPI report on 9/13. Also, the percent of a 100 basis point or full percent hike at the Fed meeting next week is now up to 34%. So inflation very much still a serious problem. We went from 4 days up to a big gap down. Today's, as I said, day one down. We'll see where it goes from there, but the trend is clearly broken. Expectations pre-market after the move lower changed this to negative with the CPI gap down, and then we trended down all day, broke support levels on the S&P and the NASDAQ 100. There really isn't any good news to be found today, except a couple of stocks that held up. But like I've said before, when they raid the house of ill repute, they will get the piano players eventually, and these ones that are holding up, like solar stocks, are the piano players. Dollar up over 1% today. In fact, up 1.38%. That's terrible for stocks. So the relief that we saw over the last 4 days, and this hooked back up on the stochastic, more bad news there. TLT was green. The rest of the bonds, the 10-year and the 3 to 5 year ETFs were lower, which means the yield curve is inverting, which means a recession, which means bad for markets, bad for stocks. Fertilizers were up today, 11 out of 11 sectors down. Semiconductors hit hard, down 6.2%. Building stocks, ITB, down 6.5%. Cloud stocks, down 5.6%. Retail, XRT, down 5.8%. Biotech tried to break out yesterday, down over 5% today. Like I said, not time to be a hero. I'm not even going to look at these charts, except for when I talk about things that we sold, because there's really nothing to focus on anymore except for capital preservation. Celsius, one of the leaders that I mentioned, down over 7% today. ON Semi, we sold that, ended up down 7%. So here's how we played it right out of the gate. Coming in, our adjusted beta was 0.85%. We had 25% SSO long, 5% Apple, 2.5% Tesla, ON, Enphase, and CCJ. Immediately we put on a 10% hedge just to stop the bleeding. When you're in a hole, stop digging. And with the gap down, let's go to a 5-minute here on the S&P 500, and we'll walk through what we did today. In markets like this, when you're free falling down, there's the quick and the dead. And we had our levels. I've mentioned before, we were up on all 5 of the SSO buys. When we enter the market, we don't want to lose more than 0.2% in any of one single buy. All 5 of them we got stopped out on. The net loss to the entire portfolio for all 5% positions was 0.98%. That's a paper cut. We can handle that. Then additionally, our stops just started getting hit. We started breaking support, and again, the market took us out. This isn't my decision to sell. It's the market saying sell. I'm just doing what the market's telling me to do. So first thing that we sold was ON, because it was underperforming. It broke to 21, and you got to protect your capital. We went to a small net loss on it, so ON was gone. Next up, we started trimming our SSO. So the 5th ad that we did hit near 0.2% of the overall portfolio loss. We sold it. Then we sold Apple. I love Apple. Use their products all the time. Apple broke the 21, the 200, and the 50. You cover up the ticker and you look at that. You shouldn't hold it. We sold our 5% Apple position for a small loss. Tesla, we just bought this yesterday. Sold it. Net impact to the portfolio less than 0.1%. Broke the 200-day moving average. Not playing around. When things start going south, you go in the reverse order. Things that you buy, if they're showing red, you get them out of your portfolio. You have small profits, then your decision is how much of the profit do you want to protect. Talking to Michael late in the day and Alex, we were CCJ went from a positive gain to a small loss, still above the 21, still above the 8, relative strength at a new high. Got to protect your cost basis in a bear market, especially with the action in the indexes. We sold it, end up for about 1.5% loss on a 2.5% position. And then end phase, great stock, great sector. I could wake up tomorrow and this could be down 5%. It bounced at the 21. We booked a very tiny loss, like 0.3% on a 2.5% position. So every holding gone, all of our SSO gone. So we're left with a 10% SDS position that's solidly profitable. And our adjusted beta is now negative, so we're net short 0.21%. Bottom line for today, inflation kills another rally. I will show a couple of things that held up today. First, solar. Again, good sector. Stock looks strong. I'm just not going to. There's a time to play and there's a time not to play. It's just not worth trying to skim a couple of percent off of something that could get blown completely apart because of the overall market. LNG raised their numbers back above the 21, closed mid-range, strong stock, stochastic hooking up. I'm not going anywhere near it. Let's see what was out. AEHR, this is a small stock, too small for us. Great story, signed a new client, up 13.5% on the day, back above the 21. This is the kind of thing where you take this time to get the stories straight, to see who has really good products, and then you just wait for the market to agree that it's time to own stocks. AEHR, too thin for us. Maybe we would take a very small position if we would, but you got to be able to get in and out. But if I had FOMO, that would be one of the stocks that I would be in FOMO mode if, and that's a big if, the market is cooperating, and right now it's not. Shockwave, another leader that we've owned but got stopped out of, positive on the day, holding the 21, but again, we're just not going to go against the tide in a market like this. Albemarle, ALB, up on the day, strong stock. Lithium, need it for EVs. Speaking of lithium, LTHM had a couple of terrible days. Bounced yesterday, bounced off the 21 again. Strong stock again. It's above the 21, but we're just not going to do it. So now what do? We focus on the indexes, and we've got a short position to manage. If it gets too extended, we'll take profits on it. Gets too extended to the downside. Right now we're watching this 3,900 support area. It's a reasonable spot to bounce. If the market panics overnight and we get a gap down, we might take it off the board then. It just depends on a lot of factors, really, how the overnight reaction is, and the rest of the charts that I'm going to go through. But really, at this point, it's identifying what's holding up the best, not what we're going to be buying. And it's just now managing the trend. And if the trend is down, if this is the true third leg lower, it can get really ugly. And we're in capital preservation mode, and that's the bottom line. That's going to wrap it for today. As always, love to hear from you. Email is don@revereasset.com. Phone is 855-REAL-WEALTH. That's 855-732-5932. Wrapping up, Bloody Tuesday, 9/13. This is Don Vandenbord reminding you it's not how much you make, it's how much you keep. Protect your capital in bear markets. That's where we are again. Thanks for listening and have a great day.